The greatest edge in the financial markets is not a proprietary algorithm, a secret data source, or an unparalleled network of contacts. It is the simple, brutal, and often ignored realization that the single biggest impediment to your success is the very mechanism you use to make decisions, your own brain. I have spent a lifetime immersed in the study of patterns, first in the abstract as a mathematician and cryptographer, and then in the concrete as an investor. The transition from pure mathematics to the applied mathematics of the market was illuminating, not because the market was a new kind of puzzle, but because it revealed a constant, predictable variable that corrupted every equation, human emotion. Most people who engage with the market, the vast majority, in fact, do so with a framework that is fundamentally flawed. They rely on intuition, on narrative, on a feeling in their gut, or on a story they have constructed about a company or an economic trend. They are, in essence, discretionary traders, and their method is a form of sophisticated gambling dressed up in the language of finance. They believe they are making rational decisions, but they are merely reacting to stimuli filtered through a dense, opaque layer of cognitive biases that are hardwired into the human operating system. This is why most investors fail. They are playing a game of probability and statistics with a mind designed for survival on the savannah, not for optimizing a portfolio in a high-frequency, non-stationary system. The market is a vast, complex, and noisy data set. It is a system of systems driven by millions of simultaneous, low-signal interactions. To extract value from this noise, you must employ a method that is equally vast, complex, and most critically, unemotional. You must replace the flawed, intuitive human decision maker with a systematic, mathematical process. The central thesis of my observation, after decades of watching fortunes made and lost, is this: the human brain, with its inherent biases and its profound need for narrative and control, is the biggest risk in investing. It is a machine for generating error in a domain that demands precision. Let us dissect this problem not with anecdotes or motivational platitudes, but with the cold, hard logic of mathematics and behavioral science. I have 4 core lessons that form the foundation of a rational approach to the market. Lessons that demand you set aside your ego and your feelings and embrace the superior logic of the system. The first core lesson is the illusion of intuition. The human brain is a magnificent pattern recognition engine. It evolved to quickly identify a predator in the tall grass, to associate a certain berry with a certain taste, and to construct causal narratives from sparse data. This ability is a survival mechanism, but in the financial markets, it is a fatal flaw. When a discretionary investor looks at a chart, they see a story, a head and shoulders pattern, a breakout, a correction, a narrative of fear and greed. They feel a sense of certainty, a gut feeling that the price is about to move in a certain direction. This feeling is not insight. It is a neurological artifact, a cognitive bias at work. Consider the phenomenon of confirmation bias. Once an investor has taken a position, say they have bought a stock, their brain immediately begins to selectively seek out and prioritize information that validates that decision. They will read articles that praise the company, they will dismiss negative news as temporary noise, and they will interpret ambiguous data in the most favorable light. They are no longer objective analysts. They are advocates for their own trade. Mathematically, this means they are systematically reducing the quality of their input data, skewing their probability estimates, and increasing their exposure to unmanaged risk. The system is designed to fail because the input filter is compromised by the desire to be right. Then there is recency bias, the tendency to overweight recent events. If the market has been going up for 6 months, the human brain assumes it will continue to go up. If a particular strategy has worked well for the last quarter, the investor doubles down on it. This ignores the fundamental principle of non-stationarity. The market is not a static system. The underlying distributions and relationships are constantly shifting. A pattern that worked yesterday may be entirely irrelevant today. By relying on recent history, the intuitive investor is always fighting the last war, optimizing for a data set that is already obsolete. A systematic approach, conversely, is constantly reevaluating the statistical significance of all data, giving appropriate weight to the past while remaining agnostic about the future, except as predicted by the current model. Perhaps the most destructive bias is loss aversion, a concept well documented in behavioral economics. The pain of a loss is felt approximately twice as intensely as the pleasure of an equivalent gain. This asymmetry in emotional response leads to two catastrophic trading behaviors. First, investors tend to hold on to losing positions far too long, hoping for a return to the break-even point, simply to avoid the psychological pain of realizing a loss. They turn a small, manageable statistical fluctuation into a catastrophic portfolio event. Second, they tend to sell winning positions too early, locking in a small profit to secure the pleasure of a win, thereby cutting off the potential for large, asymmetric gains. The system of a successful investor must be designed to maximize the positive asymmetry of returns, allowing winners to run and cutting losers quickly. The human brain, driven by loss aversion, does the exact opposite. It is a mechanism for clipping the upside and extending the downside. The market is a high-dimensional space, meaning there are millions of variables interacting simultaneously. Human intuition is effective in a three-dimensional, low-variable environment. It can tell you how to catch a ball or navigate a forest. It cannot, however, process the simultaneous impact of global interest rate differentials, commodity futures movements, and the sentiment derived from millions of social media posts. The sheer complexity renders intuition statistically meaningless. When an investor says, "I just had a feeling," what they are actually saying is, "My brain generated a spurious correlation and assigned a high degree of confidence to it." In a systematic framework, a feeling is a variable that is not in the model, and therefore it is noise, to be ignored. The illusion of intuition is the belief that a simple, low-dimensional cognitive process can solve a high-dimensional mathematical problem. It cannot. The only reliable solution is to replace the intuitive guess with a statistically validated, systematically executed hypothesis. This leads us directly to the second core lesson: the tyranny of small numbers. The success of any quantitative strategy, and indeed the success of any statistically sound decision-making process, rests on the law of large numbers. This law states that as the number of trials increases, the average of the results obtained from those trials will converge to the expected value. In the context of the market, this means that a trading signal, no matter how small its edge, can be immensely profitable if it is executed consistently, frequently, and with sufficient capital over a vast number of trades.
The tyranny of small numbers is the human tendency to extrapolate from a small sample size. An investor makes 3 successful trades and immediately concludes they have a winning strategy or a unique insight.
They then increase their position size dramatically, exposing themselves to catastrophic risk based on statistically insignificant data. Conversely, they experience 3 consecutive losses and abandon a perfectly sound, mathematically validated strategy, concluding it is broken. This is a failure to understand the difference between the expected value of a system and the short-term variance. Let us consider a hypothetical, yet realistic, quantitative model. Our research indicates that a specific low-latency signal has a predictive power that yields a 51% probability of a profitable trade over a 1-minute horizon. This is a tiny edge. A discretionary trader would scoff at a 51% win rate. They want to be right 70% or 80% of the time. But the mathematical reality is that a 51% edge, executed 10 million times a year, with controlled transaction costs and precise position sizing, is a license to print money. The expected value of each trade is positive, and the sheer volume of trades ensures that the law of large numbers takes effect, smoothing out the variance and driving the cumulative return toward the positive expected value. The human brain cannot tolerate the short-term variance inherent in this system. It sees a sequence of 10 losses in a row, a statistically probable event in a 51% system, and panics. The investor feels fear, doubt, and the urge to intervene, to fix the system. They override the model, they adjust the parameters based on their feeling, or they simply shut it down. In doing so, they destroy the very mechanism that guarantees long-term success. They trade the certainty of a positive expected value for the emotional comfort of avoiding short-term pain. The market is characterized by a low signal-to-noise ratio. The true exploitable patterns, the signals are faint, fleeting, and often buried under a mountain of random, irrelevant price fluctuations. The noise, the human brain, seeking clarity in narrative, tends to mistake noise for signal. It sees a large, dramatic price move and assigns a profound causal explanation to it, when in reality, it may be nothing more than a high-variance event. A systematic approach, by contrast, is designed to statistically filter the noise, to identify the faint, persistent signals, and to execute trades based on the aggregate probability derived from millions of such signals. The system is patient because it understands that the signal only emerges clearly over a vast number of trials. The human is impatient, demanding immediate gratification and clear, unambiguous feedback, which the market simply does not provide. To succeed, you must adopt the mindset of a casino owner, not a gambler. The casino owner knows that every game has a small, positive, expected value for the house. They do not care about the individual who wins a large jackpot. They know that over millions of hands, the statistical edge will prevail. The gambler, however, focuses on the individual win, the short-term outcome, and the illusion of control. The systematic investor is the casino owner, relying on the mathematical certainty of the law of large numbers. The discretionary investor is the gambler, relying on luck and a flawed sense of timing. The tyranny of small numbers is the psychological trap that prevents the human from achieving the necessary scale and consistency to let the mathematics work. The third core lesson is the primacy of system. If the human brain is the source of error, the system is the mechanism of correction. A systematic approach to investing is not merely a set of rules. It is a complete, self-contained, and self-correcting framework that replaces every aspect of human judgment with computational logic. The system is the embodiment of rational analysis, a perpetual motion machine of hypothesis, testing, execution, and refinement. The fundamental difference between discretionary and systematic trading is the locus of decision-making. In discretionary trading, the decision is made in the moment, under pressure, and is subject to the immediate emotional state of the investor. In systematic trading, the decision is made in advance, in the calm, objective environment of the research lab, and is executed automatically, without human intervention. The system pre-commits to a course of action based on statistical evidence, thereby eliminating the possibility of emotional override. The construction of a robust system requires a rigorous, almost scientific methodology. It begins with a hypothesis, a statistically testable belief about a persistent, exploitable inefficiency in the market. This hypothesis is then subjected to exhaustive backtesting across decades of data, across multiple market regimes, and with rigorous controls for data mining bias. The goal is not to find a strategy that would have made money in the past, but to find a statistical relationship that is robust enough to persist into the future. Once validated, the system is codified into a set of precise, unambiguous rules for entry, exit, and position sizing. The power of the system lies in its unwavering discipline. When the market is in turmoil, when prices are moving violently, the human instinct is to pause, to wait, to reassess, or to panic sell. The system, however, has no instinct. It only has logic. If the conditions for a trade are met, the trade is executed. If the conditions for an exit are met, the position is closed. The system does not care about the news headlines, the fear index, or the opinion of a talking head on television. It only cares about the data points it was programmed to process. This mechanical adherence to the rules is not a lack of intelligence. It is the highest form of intelligence in this domain because it is the intelligence of pre-commitment. Consider the analogy of a complex engineering project, such as a space launch. Every component, every calculation, every sequence is planned and tested in advance. When the countdown begins, the engineers do not suddenly decide to change the fuel mixture because they feel like it is a good idea. They trust the system because the system is the repository of all their collective rational knowledge. The financial market is no different. It is a high-stakes environment where a single emotional error can be catastrophic. The system is the checklist, the protocol, the fail-safe mechanism that ensures the mission is executed as designed, not as felt. Furthermore, a systematic approach allows for the efficient management of a portfolio of hundreds or thousands of uncorrelated strategies. No single strategy is perfect. Every model will have periods of underperformance. The human investor, with their limited cognitive capacity, can only manage a handful of ideas, and when one of those ideas falters, their entire portfolio and their psychological well-being is threatened. A systematic firm, however, can run a vast ensemble of models, each with a small positive expected value, and each exploiting a different independent market inefficiency. The failure of any single model is statistically irrelevant because the aggregate performance of the ensemble is what matters. The system provides the necessary scale and diversification that the human mind simply cannot achieve. The primacy of system is the recognition that in a game of probabilities, the collective, unemotional logic of the machine is superior to the isolated, biased intuition of the individual. The fourth core lesson is the geometry of risk. Risk to the discretionary investor is an abstract, emotional concept, a feeling of anxiety or excitement. To the systematic investor, risk is a quantifiable, geometric property of the portfolio. It is a mathematical construct that must be measured, modeled, and managed with the same precision as the expected return. The failure to define risk mathematically is the failure to manage it at all. The most common failure point for the human investor is the emotional response to a drawdown. A drawdown is a decline in capital from a peak. It is an inevitable, statistically guaranteed feature of any trading system. Even a system with a high positive expected value will experience drawdowns. They are the cost of doing business in a volatile environment. The systematic investor pre-calculates the expected frequency and magnitude of drawdowns and sizes their positions such that the maximum probable drawdown is financially and psychologically tolerable. The human investor, however, experiences a drawdown as a personal failure, a threat to their ego and their financial security. When the portfolio is down 10%, the fear response is triggered. This fear leads to irrational behavior, selling at the bottom, taking on excessive risk to get back to even, or abandoning the strategy entirely. The emotional response amplifies the financial loss. The geometry of risk demands that you treat a drawdown not as a crisis, but as a data point, a temporary deviation from the expected path that is already accounted for in the model's variance. Position sizing is the most critical tool in the geometry of risk, and it is entirely mathematical. It is the process of determining how much capital to allocate to a specific trade or strategy based on its volatility, its correlation with other assets in the portfolio, and the overall risk tolerance of the fund. The Kelly criterion, or a variation thereof, provides a mathematically optimal framework for position sizing, maximizing the long-term growth rate of capital while controlling the probability of ruin. The human investor rarely uses such a precise mathematical approach. They size their positions based on conviction, a feeling of certainty about a trade, which is the inverse of rational risk management. High conviction leads to large, reckless bets, and it is these large, emotional bets that lead to catastrophic failure. Diversification, too, is a mathematical necessity, not a casual suggestion. It is the process of combining uncorrelated or negatively correlated assets and strategies to reduce the overall volatility of the portfolio without sacrificing the expected return. The goal is to construct a portfolio where the inevitable losses in one area are statistically offset by gains in another. The human brain resists true diversification because it prefers concentration. It wants to put all its eggs in the basket it understands best, the one it has a strong narrative about. This concentration is a form of unmanaged risk. The systematic approach, by running hundreds of uncorrelated strategies, achieves a level of diversification that is geometrically superior, creating a smoother, more predictable equity curve. The system is designed to harvest the small, independent edges across the entire market, while the human is focused on the single, dramatic home run. The final element of the geometry of risk is the concept of the stop loss. To the human, a stop loss is a painful admission of error. To the system, it is a predetermined, rational boundary condition. It is the point at which the initial hypothesis for the trade is statistically invalidated and the capital must be preserved. The system executes the stop loss without hesitation because the cost of being wrong is known and accepted in advance. The human hesitates, rationalizes, and moves the stop loss, transforming a controlled loss into an uncontrolled disaster. The systematic investor understands that the purpose of a stop loss is not to be right, but to ensure survival so that the system can continue to execute the next 10 million trades. Survival is the ultimate mathematical objective. The fifth and final core lesson is the necessity of humility. The greatest barrier to adopting a systematic mathematical approach is not a lack of intelligence or resources. It is an excess of ego. The human brain is wired for self-attribution bias. When a trade is successful, the investor attributes it to their skill, their insight, their genius. When a trade fails, they attribute it to bad luck, market manipulation, or external factors. This prevents learning and correction. If you are always right when you win and never wrong when you lose, you will never identify the flaws in your decision-making process. Humility, in this context, is the intellectual recognition that the market is too complex, too vast, and too non-stationary for any single human mind to consistently predict. It is the acceptance that your intuition is a liability and that your personal judgment adds noise, not signal, to the process. This humility is the prerequisite for building a successful system. You must be humble enough to admit that a machine operating on cold logic and statistical inference can make better decisions than you can. The systematic investor is not seeking to be a market guru or a prognosticator. They are seeking to be an engineer of probability. Their success is not measured by the brilliance of a single trade, but by the robustness of the entire framework. They are content with a small, persistent edge, executed with machine-like consistency. They understand that the goal is not to predict the future, but to manage the probabilities of the present. The journey from discretionary to systematic investing is a journey of self-conquest. It requires you to consciously override millennia of evolutionary programming. You must replace the thrill of the chase with the calm of the algorithm. You must replace the narrative of the market with the geometry of the data. You must replace the pain of loss with the acceptance of variance. This is not easy, but it is necessary. The market is an unforgiving environment, and it will ruthlessly exploit the predictable, emotional weaknesses of the human mind. The ultimate irony is that the most successful investors are those who have effectively removed themselves from the decision-making loop. They have outsourced the emotional, high-pressure task of trading to a system that is incapable of fear, greed, or hope. They have transformed investing from an art of intuition into a science of execution. I have laid out the case for why your brain is the biggest risk. It is a machine that generates biases. It is incapable of handling the scale required by the law of large numbers. It resists the necessary discipline of a pre-committed system, and it fails to treat risk as a quantifiable geometric property. The solution is not to try and be a better human investor, but to stop being a human investor altogether. The market is a statistical phenomenon. Treat it as such. Now, I ask you, the viewer, to engage with this idea not emotionally, but analytically. If you found this dissection of the market and the mind to be a valuable statistical insight, I encourage you to like this video. It is a small signal that helps us refine our own distribution model for content. More importantly, I want you to internalize this lesson. In the comment section below, I ask you to write one concise sentence, no more, no less, explaining how you will apply the lesson of systematic, unemotional thinking to your own financial decisions starting today. This is your first act of pre-commitment. In conclusion, remember this: the market does not care about your feelings, your hopes, or your narratives. It is a relentless, probabilistic machine. Long-term success is not a function of superior foresight. It is a function of superior process. Remove the emotional variable. Trust the mathematics. Trust the system. And you will survive the tyranny of your own mind. Thank you. Task.